Good morning, my fellow Alaskans. How are we all doing today? It is great to see you. It is Friday. The week is almost over with for most of us, and the weekend is about to begin. We are here today with the Alaska Senate Finance Committee, and they are getting to hear the revenue forecast from the Department of Labor. Adam Crum will be up on deck on top of a couple of other people that will be here today, and they will be expressing everything they have made in the last 6 months. So the way it works is you got the Alaska fiscal cycle, and it begins in July 1st of 2022, and it will end June 30th of 2023, and that will be the total revenue that we get to hear about here today. It looks like they've got themselves going here in the background, and yep, they do. I'm going to go ahead and swap them over.
We have an interest in that, and we have the Commissioner Designee, Mr. Adam Crum, who we're well aware of in his previous role. If he could come forward, please. He has a couple of trustee aides that he could bring up in a minute after he introduces himself to the committee, gives the committee a brief background and introduction of who he is and his new role.
Thank you, Mr. Chair. For the record, Adam Crum, Commissioner Designee for the Department of Revenue. It's a pleasure to be here today, sir. Thank you for having us. So previously the Commissioner for the Department of Health and Social Services, and then since July 1, the Commissioner for the Department of Health. So as we enter into this new phase, trying to step up and bring forward stability to the department. Department of Revenue has had a number of turnover of different commissioners through the years, and so wanted to make sure that could bring forward a trusted face for the governor, but also relationships with the legislature as we bring forward a lot of items that we're trying to work on over the next couple of years. I think all bodies, both executive and legislative, are trying to work together on fiscal stability and a plan throughout the state. And so I'm excited to just work with the talented team that we have at the Department of Revenue.
Okay, if you could briefly give us your finance background.
Thank you, sir. So I do not have a long finance background directly. I'm a serial entrepreneur in the fact that I own a number of different companies and LLCs. So I've got a lot of investment experience that way through the community, lines of credit, banking aside. And then working with the Department of Health and Social Services was the largest department both by positions as well as by budget aspect.
Okay. So we're going to give Commissioner Designee Adam Crum a little flexibility today because we know he is new to the department. And we'll give him some time to come up to speed with a lot of the details because there is a lot of details that are different from his previous commissioner's duty, which he did very well at. So with that, I'd like to go ahead and ask Dan Stickel to come up and Colleen Glover, if they can come up and save their boss from the questions that would come down the table from the Finance Committee members.
Thank you, Mr. Chair.
You're welcome. And we'll go ahead and have you guys introduce yourself, walk through your presentation. You've both been here many times, and for those watching at home, we'll have the presenters go through their presentation a slide at a time, and we'll take questions at the end of the slide. And if you don't have the answers to the questions, because we don't even know what we're going to ask, don't let that bother you. You're more than welcome to get back to us in more detail. So with that, Commissioner Crum, you want to lead off there with your two crew?
Thank you, sir. For the record, this is Commissioner Designee Adam Crum. So taking on the role of the Department of Revenue is a lot easier when you have staff like this. As you all are aware, we've got experienced director of the tax division, Colleen Glover, as well as the head of our economic research group, Dan Stickel. He's the chief economist for the Department of Revenue. He's an experienced at providing this presentations. He helps work together the revenue sources book. And so his information, his experience in this field is just invaluable to the state. And I will pass it off to Dan.
Okay. Mr. Stickel, who are you?
Sure, thank you, Mr. Chairman. Dan Stickel, Chief Economist with the Alaska Department of Revenue.
And you've kind of give the public just a real brief history of how long you've been there and why we should listen to you.
Absolutely. So I'm a longtime Alaskan. I grew up here in Juneau, a proud graduate with a management degree from the University of Alaska. Joined the Department of Revenue in 2004 as a non-petroleum economist, and then served as a petroleum economist, worked on many of the oil tax proposals and gas line proposals, from PPT to ACES to SB 21 when that was enacted. I've been serving as the chief economist of the Department of Revenue since 2016.
Okay, and maybe we'll just do Ms. Glover real quick and get those introductions out of the way, and we'll get into the meat of the presentation.
Good morning. This is Colleen Glover, the Tax Division Director. I've been in this role for the past 4 years now and with the state for 6 years. Previous to the Tax Director, I served as commercial analyst for the Department of Revenue and actually the Department of Natural Resources and the Division of Oil and Gas. Prior to that, my background was oil and gas, and I worked at Alyeska Pipeline for 20 years. I was not born in Alaska, but I was raised in Alaska and live in Anchorage and been there for 40-plus years.
Okay, thank you. Okay, Mr. Stickel, go ahead and tell us if we have any revenue to do a budget.
Awesome. Mr. Chairman, we do have revenue. Unfortunately, the forecast is a little bit lower than the spring revenue forecast, but hopefully not too many surprises in here. So thank you for the opportunity to present our revenue forecast. On slide 2, just have an agenda for the presentation. We've broken the presentation into 4 main sections. First, I have a little bit of background about the revenue forecast and some of the key assumptions that went into the forecast. Then I'll walk through the revenue forecast, first looking at total state revenue, and then digging in with more detail on the unrestricted revenue forecast, which is of the greatest consequence to the budget. And then we have some additional detail on the key assumptions around the oil and gas revenue forecast. And finally, at the end of the presentation, we have an update from Director Glover related to our oil and gas production tax audits.
Okay. Next slide, please.
So slide 4 is just some background about the revenue forecast. The fall forecast was published in December in the revenue sources book. Sometimes you'll see that abbreviated as the RSB. And we'll be doing a spring update to the revenue forecast sometime in either March or April to help with final budget decisions. The revenue sources book, it's an annual publication. We have detailed information about all of the state's revenue sources and tax types. We produce a 10-year revenue forecast for all of the major revenue sources using models in our economic research group. And the revenue sources book does fulfill a statutory obligation. There's a statutory obligation for the governor to provide a revenue forecast for the current and next fiscal year, and then also a statutory obligation for a 10-year fiscal plan. So slide 5 looks at some of the key assumptions behind the fall forecast. And we want to stress that we live in an uncertain world. The recent situation with COVID in China has shown that there's still uncertainty around the continuing pandemic. And the ongoing war in Ukraine speaks to the geopolitical uncertainty. So we want to point out that the forecast is one potential scenario within a range of potential outcomes. And so for that reason, we've laid out what those key assumptions are in our baseline scenario in the forecast. The investments forecast assumes a 7% annual return for the permanent fund this fiscal year and a long-term assumption of 7.05% for fiscal year 2024 and beyond. And those return assumptions are starting from the June 30th, 2022 balance, which was about $76 billion in the permanent fund. Looking at federal revenue, we've incorporated all known stimulus funding as of the beginning of December of this year. That includes all of the various COVID stimulus bills that were passed by the federal government and also includes updated estimates for state funds from the infrastructure package passed last year. Looking at the petroleum revenue forecast, we're assuming $88.45 per barrel for annual or fiscal year average price for Alaska North Slope oil for fiscal year 2023, and then we're assuming $81 per barrel for fiscal year 2024, and that price stabilizes at about $75 by the end of the forecast period. Looking at the non-petroleum side of things, The forecast assumes that underlying economic activity for things like the corporate income tax have largely returned to a more normal situation following the COVID-related pandemic and recession. There is some talk of an economic slowdown. The forecast presumes that if there is any potential recession would be mild and short-lived. And then looking at tourism in particular, we're assuming that cruise ship passengers and tourism will continue to bounce back this year. We're using a baseline capacity of assumption of a little over 1.6 million passengers. We did apply a slight adjustment downward to that for this year and next, a 90% adjustment for this year to acknowledge some of the uncertainty. And then finally, looking at the mining industry, this is another one that we point out on the non-petroleum side of things. We use the futures market to predict minerals prices, and the outlook for various minerals prices has reduced a little bit from the spring forecast, similar to the oil price outlook. So still looking at a robust activity in the mining industry, and but a little bit lower on the revenue side than what we were forecasting in the spring.
And then on this slide or later on, are we going to touch on any potential or the potential comfort level of the $88.45 for this current fiscal year projection if we may go underwater or end up above water?
Sure, Mr. Chairman. What I can say regarding the oil price forecast is we ran an updated revenue estimate actually just at the beginning of this week, and we're largely on track as far as oil price goes for fiscal year 23 and 24. The futures market has not moved a whole lot since we released the forecast. That said, we are in a continued period of historically high uncertainty, so there's a wide range of possibilities and uncertainty around the oil price forecast in particular.
Okay, thank you. Next slide, please.
So slide 6 is for the visual folks. This is a graphic that shows the relative importance of different sources of total state revenue for fiscal year 2022. You can see that federal revenue and petroleum revenue made up the majority of total state revenue in fiscal year 22, and investment earnings were actually negative. Investment showed net losses for the first time since fiscal year 2009. Would point out that was coming on the heels of fiscal year 2021, which had record investment earnings. So really a reflection of just pulling off of all-time highs in the investment markets there. And then all other revenue sources combined made up a little over 12% of total revenue in fiscal year 22.
Okay, next slide.
And fiscal year, the next slide, slide 7, shows a similar chart, but looking at our fiscal year 2023 forecast without the distortions of those investment losses. And you can see that for the current fiscal year, we're expecting that investment earnings, federal revenue, and petroleum revenue will all contribute roughly a third of total state revenue, and then all other sources combined are expected to contribute a little over 7% of total revenue this fiscal year. So it really is a three-legged stool of investment, federal, and petroleum in terms of state revenue.
Okay, next slide.
Moving on to slide 9, this is a table that summarizes some of the key changes to the unrestricted revenue forecast between the spring 2022 forecast and then the fall forecast that was released last month. For oil prices, our forecast for Alaska North Slope average oil prices has been decreased by $12.55 for fiscal year 2023 and by $9 per barrel for fiscal year 2024. The spring forecast came out during a period of extreme uncertainty. We released that just as the war in Ukraine was starting, and there was a lot of volatility in the oil market. So the new forecast really represents kind of a stabilization in prices that we've seen over the last several months. For the permanent fund transfer, the fiscal year 2023 transfer was known. in the spring, so there's no change to the fiscal year 2023 number. The expected transfer for fiscal year 2024 has been reduced by about $75 million. That's based on the lower investment returns that we did see for the last fiscal year. Looking at total unrestricted revenue, the forecasts were reduced by about $1.1 billion for fiscal year 2023 and about $655 million for fiscal year 2024. And the lower oil price expectation is the primary reason for those reductions to the forecast. Not shown on the slide is oil production. There was a slight reduction to the fiscal year 2023 production outlook and a very small increase to the fiscal year 2024 production outlook.
Could you help explain on the permanent fund transfer why the $3,360,000,000 didn't fluctuate in the mechanics of the look back?
Sure, Mr. Chairman. So the permanent fund transfer to the general fund is based on the average ending value of the first 5 of the last 6 fiscal years. So it's 5% of that average ending value. And what that does is it allows the legislature to know with certainty what the permanent fund transfer will be when they're setting the budget for a given fiscal year. So at this point, the transfer for fiscal year 2024 is known with certainty as we're setting the fiscal year 2024 budget.
So it's roughly 46% of our unrestricted general funds is stable and predictable when we do our budget, leaving us the volatility in oil on the other roughly 46%. And the rest is other taxes and revenue.
That's correct.
Okay, next slide number 10, please.
So slide 10 is the last slide I'll show that looks at the total state revenue. The following slides will start to dig in on the unrestricted general fund revenue in particular. But this shows total state revenue from all revenue sources for fiscal year 2022, as well as the fall forecast for fiscal year 23 and 24. In the revenue forecast in the budget, you'll see that revenues are broken out into four categories of restriction. So those unrestricted general fund revenues, those are the revenues that can be appropriated for any purpose at all. And those are usually the focus of most of the budget discussions because there's the most discretion around how those revenues can be used. The designated general fund revenues, those are technically available for appropriation but customarily used for some specific purpose. An example of a designated general fund revenue would be that half of the revenue from the alcohol tax is customarily appropriated to alcohol and drug abuse treatment and prevention activities. The other restricted revenue, those are funds that really are dedicated in how they must be used in some way and are not available for general appropriation. An example of other restricted revenue would be the constitutional dedication of royalty revenues to the permanent fund, or the requirement that fuel tax revenue from aviation must be used to support specific activities per federal law. And then finally, we consider all federal revenues to be restricted in the forecast as there's different provisions around how those revenues have to be used. So in total for fiscal year 2022, total state revenue was about $8.7 billion, and we're forecasting a little over $15 billion in total state revenue for fiscal 23 and 24. The unrestricted general fund portion of that was $6.9 billion in fiscal year 2022, and we're forecasting $7.2 billion in fiscal year 2023 and $6.9 billion again in fiscal year 2024.
Okay, next slide.
So the next couple of slides dig in on the unrestricted general fund revenue for various sources. So this slide 11 looks at the investment unrestricted general fund revenue. So investments are one of the two largest sources of unrestricted revenue, along with petroleum. Investments contributed just under $3.1 billion of unrestricted revenue in fiscal year 2022, and then $3.4 billion is the forecast for fiscal year 2023 and $3.5 billion for fiscal year 2024. The main element of that is the percent of market value transfer that began in fiscal year 2019. Petroleum revenue generated about $3.5 billion of unrestricted general fund revenue in fiscal year 2022 and forecast at $3.4 billion in fiscal year 2023 and $2.9 billion in fiscal year 2024. And then finally, non-petroleum revenue sources are forecast to contribute about $450 million in fiscal year 2023 and about $474 million in fiscal year 2024.
Okay, next slide, please.
And looking at slide 12, this is a little bit more detail on the investments portion of unrestricted revenue. The permanent fund transfer alone is expected to account for between 43 and 62% of unrestricted revenue over the 10-year forecast period. The permanent fund transfer contributed about $3.1 billion in fiscal year 2022, and that's estimated at $3.4 billion in fiscal year 2023 and $3.5 billion in fiscal year 2024. In addition to the permanent fund piece, there's a small additional amount of other unrestricted investment revenue.
Excuse me.
The other investments represent
Fingers here. Sorry about that, Dan. Go ahead.
so the other investment revenues, those are primarily earnings on the cash balances of the general fund. You did see a net loss there in fiscal year 2022. That has to do with losses in the bond market as interest rates increased, but we are expecting a return to positive revenue beginning with this fiscal year there.
We have a question from Senator Wilson.
Thank you, Mr. Chair. And just on this topic, but not in this presentation, I don't see, but in the DNR source book and the permanent fund management and retirement in terms of investment revenue, is there a similar table? There's a table that talks about the management fees for the ARM board and for the permanent fund management. We don't see one for Treasury. Is there one that's developed? And if so, can the committee get a copy of that?
Through the chair, Senator Wilson. Yes, sir. We can actually put that forward to the committee.
And that was Commissioner Designee Crum. Okay, go ahead and continue.
Dan Stickel again for the record. Looking at slide 13, this slide shows the estimated transfer from the permanent fund to the general fund for fiscal year 2022, as well as each year for the next 10 years. We are forecasting stable growth in the amount of that transfer on the assumption that there will be continued growth in investment markets. So the transfer is expected to start at, it was a little over $3 billion in fiscal year 2022, and we're expecting that to grow to $4.5 billion by fiscal year 2032. The permanent fund transfer assumption is based on an assumption of a 7.05% long-term annual fund and a 5% annual payout. So we're actually, over time, we're paying out a little bit less than the long-term returns on the fund. Again, as I explained earlier, given that the transfer is based on a lagging average value of the fund, it ends up being a fairly stable and predictable source of revenue. Do want to point out this is a baseline forecast and does not include any potential additional draws beyond the statutory 5% POMV.
And then could you please add in the inflation component of this? What do you use for inflation, and give us an estimate of the real purchasing power possibly of the transfer?
Sure, Mr. Chairman. So the inflation assumption embedded in the forecast is 2.25%, and be happy to update this slide with an inflation adjustment to show it in real terms. But it's going to be a more stable number in real terms.
It's going to look virtually horizontal.
That's virtually correct.
Okay. And if you could update that for the committee, that'll be handy because we'll be looking at spending some time on forward projections, especially over the next 4 to 5 years, to make sure we don't run out of cash before we get too concerned about our 10-year plan. Okay. Next slide, please.
So slide 14 turns to unrestricted petroleum revenue. So there's 4 primary sources of unrestricted petroleum revenue. The first is a state property tax. We levy that on all oil and gas property in the state. It's a fairly stable revenue source, generating a little over $100 million per year for the state. Note there's also a municipal share of those property taxes that generated nearly $450 million for municipalities in the latest fiscal year. So the state is only getting a minority share of the property tax revenue on the oil and gas industry. The state has a corporate income tax that is levied on qualifying corporations doing business in the state. So this applies to most, but not all, of the oil producers. With the improved price environment in the industry, we're forecasting $390 million in fiscal year 2023 and $320 million in fiscal year 2024 from that corporate income tax. Something that I've mentioned in prior years is there was a provision of the Federal CARES Act that allowed corporations to carry back any net operating losses in calendar years 2018, 2019, and 2020. They could carry those back and receive a refund for prior year taxes paid. And Alaska adopted those provisions by reference. So we automatically applied those carryback provisions to our state corporate income tax. We estimate that the reduction in fiscal year 2022 petroleum corporate income tax from those carrybacks was about $79 million. And then we're not forecasting any further impacts from those CARES Act refunds in fiscal 2023 and beyond. Looking at the oil and gas production tax, that's the state's severance tax on petroleum. For North Slope production, we have a net profits tax combined with a gross minimum tax floor. At the forecast prices in the fall forecast, we're expecting that most companies will be paying above the minimum tax floor throughout the time horizon of the forecast. And the production tax is expected to bring in a little over $1.6 billion in fiscal year 2023, and then a little over $1.2 billion in fiscal year 2024.
So before you go to the, oh, excuse me, you're not done yet. Go ahead, continue. I just saw you turn the page, but go ahead.
Yeah, Mr. Chairman, continuing on, the final source of unrestricted petroleum revenue is oil and gas royalties, which also include bonuses, rents, and interest. Royalties from oil and gas production on state land brought in about $1.3 billion of unrestricted revenue in fiscal year 2022, and forecast at $1.3 billion in fiscal year 2023 and $1.2 billion in fiscal year 2024. The royalties revenue and forecasts shown here only represent the unrestricted general fund portion of royalties. The state also gets a substantial portion of royalties are dedicated by constitution to the permanent fund, and then a smaller amount is dedicated to the school fund. And then a few slides later in the presentation, we'll dive in a little bit more detail on the assumptions that went into this petroleum revenue forecast.
So one of the subjects that we had at the table last year or so has been the corporate income tax alterations that the federal government has made. And could you help me understand what you meant by reference?
Sure, Mr. Chairman. So we have the provision of our tax code adopts the federal tax code. So we adopt most provisions of the federal corporate income tax code unless we specifically opt out of those. And we adopt those in real time, so it's a rolling conformity. And so when the federal government makes a change to their corporate income tax, such as a change to how net operating losses can be applied, unless we specifically pass a law to opt out of that, we automatically adopt that in the state's corporate income tax code.
Right, as I recall, that change went to all C corps. It wasn't specific to the one particular industry. Is that correct?
That's correct, Mr. Chairman, and yes, that was also relevant to the non-petroleum corporate income tax, which I'll discuss on the next slide.
Okay, and then thank you for delineating out also the royalty split between restricted and unrestricted and property tax, because there's a lot of new members in the building and new workers, and we need to make sure that they recognize that, because it's an easy mistake to make in the beginning. It's counting only portions of it, the portion that comes to the state versus the entirety of the tax. So thank you for that. Next slide, please.
Sure. So slide 15 does show additional detail for the unrestricted non-petroleum revenue. And for the non-petroleum revenue in particular, there are a lot of designations and dedications. So a lot of the non-petroleum revenue is considered designated general fund or other restricted. So just to point out that the amounts up on the screen here are only the unrestricted general fund portion of any of these revenues. So the largest component is taxes, and typically the corporate income tax is the largest of those non-petroleum taxes. Generated about $112 million in fiscal year 2022, and we're forecasting $105 million in fiscal year 2023 and $125 million in fiscal year 2024. Similar to the non-petroleum, or similar to the petroleum corporate income tax, we did adopt those provisions of the federal tax code that allowed for carrybacks of losses during the pandemic. And the fiscal year 2022 revenues shown here included refunds of an estimated $80 million for those CARES Act refunds. Our forecast on corporate income tax is based on earnings projections and accounts for the potential of an economic slowdown. Revenues have been coming in fairly strong so far this fiscal year, but we're expecting those to start to decrease into 2023. Other significant taxes include the mining license tax, insurance premium tax, fisheries taxes, and a variety of excise taxes. And in total, those non-petroleum taxes are expected to generate about $330 million in fiscal year 2023 and about $335 million in fiscal year 2024. And the remaining of this, the remaining unrestricted non-petroleum revenue in that other line at the bottom is a variety of different sources. It's licenses and permits, charges for state services, fines and forfeitures, any non-petroleum rents and royalties, and miscellaneous revenues like dividends from state corporations.
Senator Wilson.
Hey, Mr. Chair. Mr. Stickel, can you explain the decline in the mining license tax from year 23 to FY24?
Sure, Senator Wilson through the chair. So we're expecting a modest decrease in mining license tax based on the expectation that minerals prices will moderate a little bit, and we've also seen cost pressures in the industry with some of the cost inflation that we saw. So we're forecasting that costs will increase and value will start to pull back a little bit from the highs of last year. The mining license tax is a net profits tax.
Senator Bishop.
Would it be safe to say that you would attribute that downturn to directly related to the price of fuel?
Senator Bishop through the chair. So the price of fuel is a significant operating cost at some of the mines. So that's definitely one of the contributors there.
Thank you.
Okay, next slide, please.
All right, so the final, or the next set of slides looks at some of the key assumptions for the petroleum revenue forecast. We'll look at oil prices, oil production, company spending, and then tax credits. So slide 17, starting with oil prices. This slide shows our fall 2022 oil price forecast for Alaska North Slope crude and a comparison to the spring 2022 forecast. We use the futures market as the basis for our oil price forecast. This allows us to have a very timely and transparent methodology for producing the oil price forecast. For the forecast, we use the futures through fiscal year 2029, which was the final year that we had data available, and then we applied an inflation adjustment for fiscal year 2030 and beyond. The price forecast was generated on December 7th using futures data for the first 5 trading days of December, and did result in a decrease for fiscal year 2023 of $12.55 per barrel compared to the spring forecast, and then a decrease of $9 per barrel for fiscal year 2024. Once you get on to the later years of the forecast, the decrease was only a couple dollars per barrel. Again, just to reiterate, when we made the spring forecast, and you can see the big spike and then drop there in 2022, we made the spring forecast right as the Ukraine situation was unfolding, so there was a lot of volatility and uncertainty in the market, and that was really reflected in the outlook for the next couple of years in particular, whereas the longer term range for oil prices didn't change a whole lot from the spring forecast.
So do you solely rely on the futures market for your forecast?
Mr. Chairman, yes, we do.
So could you restate the graph and go back to the same time frame in each given year? You can pick if it's January or June, it doesn't really matter, 1-year increments, and put the futures market prices on a graph.
Yes, we can do
Because
that.
I would expect that there's no convergence in 2028.
Sure. Yeah, Mr. Chairman, so the futures market tends to be fairly volatile in the front months. When you look at the longer term prices, there's a little bit less volatility, so a little bit more of a convergence in the out years than the front months. But
Right, but correct, but if you can go back to like 19 and state that, because I think we're going to see that 26, 27, 28 point move around quite a bit is what I expect. We'll wait till you bring it back. So, and the point being, if it's all over the map, it's hard for us to put much validity in it for a 10-year forecast.
Sure. Yeah, Mr. Chairman, we'd be happy to produce that. And just to reiterate the earlier comment about uncertainty, which I think is the point that you're getting at, we are in a period of historically high volatility. We have been ever since COVID hit, and the forecast here is one most likely case within a wide range of potential outcomes.
Mm-hmm. Okay. Go to the next slide, please.
So slide 18 is a comparison slide showing, again, our most likely case for oil price forecasts compared to several other sources. This chart was updated earlier this week. For this chart, we compare the fall forecast from the Department of Revenue to the current Brent futures prices, as well as an outlook from the Energy Information Agency of the U.S. federal government, and an average analyst forecast. We compare to Brent because that's the benchmark crude. It's the global benchmark crude, and Alaska crude usually trades in a price very similar to Brent crude. You can see in general, the different sources suggest a most likely price range in the $70 to $80 per barrel range over the long term. It's interesting that the analysts in particular seem to have a slightly higher view of potential oil prices than the futures market or the Energy Information Agency, but still in that same general range.
Could you also on this chart bring back the numerics for 23 and 24, kind of, and maybe even 25, just a shorter range with those different, the futures market and energy information in your forecast, so we can kind of see the numerics on it, because we're going to be spending some time on cash flow analysis, and we want to see the range of forecasts, and then where the department recommends where we land to use, as our main return.
Absolutely.
Help us
happy
with
to do
that. Because we're going to have you back, as you can tell, to talk about some of this stuff, so we'll get you prepared. Okay, next slide, please.
All right, and
Bear with me, folks, here. I am trying to figure out why this broadcast has just stalled out. And, bear with me, folks, here. I am trying to figure out. I got making sure my volume there is going. Let me see what it's if I can do a refresh here. Get it to start right back at 9:40 a.m. so we're not missing any of this.
line here, the line should be at, the vertical line should be at $81 per barrel, and the horizontal line should be at $3.4 billion.
You could restate that. I was going to ask you why you picked $100, but that's fine. You could restate that. And
Sure. Yeah. We'll submit an updated version. I believe it may have got transposed when we converted from PowerPoint to PDF.
oh, that's fine. And then
Technical difficulties.
maybe do a little sensitivity table to help everybody at $5 increments or over a $20 range or something like that. Or you can even do a dollar.
Oh man, it
increment
won't
over
let me
$20 range.
rewind this thing. That's the
couple
difference
minutes to
between
do that.
being on Gavel and being on a
it would
live
help, I
stream
think,
with them.
the-
Sorry about
a
the
lot of the
stall
folks
out
that
there.
aren't as familiar with this
Some reason
see,
it just completely did.
the revenue change per slot.
But we're back on track again.
For the price change, because, from here out, every time they look at the price, it's going to be a different number than it is today. Till we get out of here, so.
Sure. Yeah, Mr. Chairman, so we do have, in Appendix A of the Revenue Sources book, we do have some numerics showing price sensitivity to revenue, and then we have an expanded, a document showing an expanded sensitivity analysis over the 10-year forecast that we'd be happy to provide with the committee.
Okay.
So moving on to slide 20, if I may. This is a little bit of review from Wednesday's presentation from Department of Revenue, or Department of Natural Resources. So this slide shows the forecast for North Slope oil production over the next 10 years, as well as a high case and a low case over the 10 years. So in general, the production forecast shows a fairly stable to slightly increasing oil production outlook over the next decade. And that's really, the story there is that there's a balance of the natural declines in the mature existing fields being balanced by additional drilling and optimization in those fields, as well as the expectation of some new fields coming online. When we're looking at oil production, we want to recognize that the production forecast, as with the rest of the forecasts, are a most likely value taken within a range of possible outcomes. And so for that reason, we show a high case and low case on oil production. And you can see that Just based on the fields that are currently in the forecast, production by fiscal year 2032 could be over 800,000 barrels per day, or it could be under 300,000 barrels per day. So a wide range of potential there.
I think it's unlikely we're going to be at the bottom after listening and meeting with the industry. The basin seems to be holding up very well. In fact, increasing, and you're going to probably get into that here in a minute.
That would be the hope, Mr. Chairman.
Okay?
Slide 21 then is just a comparison of the fall production forecast to the prior spring production forecast. The best way to interpret this is that there was very little change to the production forecast for the next several years. Generally, projects have been progressing about as they were expected in the prior forecast. You'll see in fiscal year 2028 and beyond, there are some minor differences comparing the two forecasts. That is primarily has to do with updating some of the expectations around when some of those new fields will come online, as you heard about a couple days ago.
Okay, on that chart, I'd like you to also restate this chart and truncate it somewhere maybe around 26, because don't they, the industry gives you a report out 5 years, a couple times a year, one formal one update, is that correct? And potential expenditures and what they're looking at coming?
Sure, Mr. Chairman, so we meet with industry to gather information for the revenue forecast. There's two main components that we get for that. There's some production information, and that's actually a 10-year outlook with follow-up discussion with the industry.
Right, and the reason I ask that is it's easy to get delirious on 2031, but it's a long ways out. And if we shorten that out to shorten it up to the point that you have better data 4 or 5 years out, it'll fit the time horizon that the finance committee is going to be concentrating at cash flow analysis. So it kind of links up. Also, I think what's not reflected here because of the scale of the charts is the increase that we're having on the north slope. In the forecasting I've looked at internally, there's some anomalies. And the anomalies are on the high side, not on the low side. And that appears to be from Hillcorp and their different management style than the predecessor BP and the management of Prudhoe Bay and the other fields, along with ConocoPhillips and the hard work that company's done. So I think there's some real positive news in the uptick in production that could be, that I'd like to see reflected in our data charts. So, it's easier for the legislators and the workers here in the building and a couple other fields online in the next, half a decade or a little bit longer. So if you could help us with that, and when there's good news at the table, we'd like to have some of the news, good news highlighted before we talk about the other stuff that we have to deal with.
Absolutely, we'd be
Better than anticipated. Do you see any of that in any of your quarterly or monthly data, by chance?
Sure, yeah, Mr. Chairman. So there are definitely some fields that are coming in a little bit stronger than expected, and then there are other fields that are coming in a little bit lighter than expected.
And hopefully the bigger ones are the stronger ones and the net number is positive, is that correct?
So for the current fiscal year, for fiscal year 2023, there's been a slight reduction to the forecast. So the forecast is now that production will increase a little less than we were expecting in the spring. So I would characterize that what we've seen over the recent months might be a little light of what we had been expecting, but it's still moving in the upward direction. Yeah. So a smaller increase is still good news.
All right. Because it's been a concern at the table, to slow slow the natural decline down of the field and hopefully get it turned around, which appears to be at least slowly migrating up instead of erosion down, hopefully for the next couple of years.
Yeah, absolutely. And to be clear, Mr. Chairman, absent significant work being done by the current and new operators, production would be expected to be on a precipitous decline in a mature oil basin. So the fact that we're forecasting stable to slightly increasing production is good news and reflective of lots of hard work being done by the industry.
And if I could make a recommendation on the presentation, just due to the volume of new members in the legislature, new employees, it would be nice if you do the presentation in the other body, that the department take a little bit of time on the background of the natural decline of a field, so it's recognized, or more easily recognized, the effort and expenditures to slow down and then turn around the aging field, the aging basin, which is no easy task or inexpensive task. It would help just the backgrounds. We got a lot of education to do in the building, so we can have robust policy discussions with some reality behind them. So, okay, if we can go to the next slide, please.
All right, so slide 22 looks at a 10-year history and forecast of allowable lease expenditures for the North Slope. And we also include a history of annual average oil and gas employment so that you can see the strong correlation between spending and jobs. So the allowable lease expenditures, these are the costs of production reported on tax returns because they are deductible in the production tax calculation, which is a net profits calculation. Company spending is also an important metric to look at how much are companies investing in Alaska and what is the plans for future investment in the state. So in fiscal year 2022, North Slope capital expenditures were $1.4 billion and operating expenditures were $2.5 billion. The fiscal year 2022 numbers reflected continued low spending after the pullbacks that companies made in the COVID recession between COVID and the low oil prices that we saw in 2020. We're actually seeing over the last several months with this winter season that activity is picking up. So that's a really good sign, and we're forecasting a significant increase in capital expenditures for the current and next 2 fiscal years as companies are resuming activities and starting to invest in some of those major new developments, such as Pica and Willow. And we're forecasting that capital expenditures will stabilize in this $2 to $2.5 billion per year range over the long term. Looking at operating expenditures, companies really pulled back as much as they could during COVID and the low prices that we saw in 2020. We are forecasting that operating expenditures will slowly increase from current levels due to a combination of general cost inflation as well as new developments coming online. And we expect that those operating expenditures will reach $3 billion per year in fiscal year 2028 and slowly increase from there. A note on how we derive these cost forecasts is we do require cost forecast submissions from the operators of any units in the state. So we actually get expectations from the industry themselves on what their planned capital and operating expenditures are for the next 5 years. And then we have different meetings with the companies and supplement that with information from tax returns and public information about future developments.
And that complete the slide?
Yes.
Okay, Senator Bishop.
Thank you, Mr. Stickel. Welcome. Good to see you. What line are you capturing the drilling under? Capital or operating?
Senator Bishop, through the chair, so most drilling is going to be considered a capital expenditure.
And so, follow-up, Ron? Work over rigs?
Senator Bishop, through the chair, I think those would primarily be in a capital expenditure, but some of that might also fall into the operating category.
Thank you.
Okay, and then if you could also restate this chart and add the non-deductible expenditures, both operating and capital, and even if it's a separate slide. And the reason I say that or ask that is just so the newer folks in the building can recognize not all expenditures are referenced in the deductible expenditures. So that, and that would be helpful. And I know it's in the revenue source book, but it'd be nice to have it depicted here. Senator Olson.
Thank you, Mr. Chairman. Mr. Stickel, as you look at the chart that's up there and the prediction with the expenditures going out to the right, are you anticipating that there's not going to be much exploration going on up there as the light flattens out and some of the numbers stay down? Is that what am I interpreting that correctly?
Through the chair, Co-Chair Olson, so the projection of capital and operating expenditures includes an assumption that there will be a modest amount of ongoing exploration. I think we're assuming something on the order of 4 exploration wells per year. So a modest exploration on an ongoing basis.
Follow-up question, Mr. Chairman.
Yes.
Does this also include NPRA lands as well as some of the other state and federal lands that are outside of the NPRA?
Sure. Through the chair, Co-Chair Olson, the allowable lease expenditures shown here represent all expenditures that would be subject to state production tax. So this is anything on any land in the state and within the state's 3-mile limit.
Thank you, Mr. Chairman.
Any other questions? Senator Bishop.
Man, I'm asleep at the switch here, but it would be interesting to, you didn't forecast the employment numbers. Am I correct?
Senator Bishop, through the chair, so we in Department of Revenue are not forecasting employment numbers. I believe there are some long-term projections that come out of Department of Labor. The reason I didn't include those on this slide is that they're really two different data sets. Mm-hmm. So our forecast of capital expenditures and operating expenditures might not necessarily align with the long-term projections that came out of Department of Labor.
Thank you.
And just a clarification from the other day, we asked DNR about deductible and non-deductible expenditures, and it's really a question for you folks to answer. So when your phone rings and they ask you for the data, tell them you already heard it firsthand. And they don't, so it's not doubled up or.
Sure. Mr. Chairman, I would be happy to provide that supplemental data. And just for the committee's benefit and the folks watching at home, when we talk about total and deductible lease expenditures, so the total lease expenditures shown here on typically those deductible lease expenditures are going to be your producing companies that have enough oil production to apply those costs against their tax liability. And then what we refer to as non-deductible lease expenditures are going to be primarily the expenditures from companies doing exploration and development.
And do they not carry over as a forward credit to be used later? Is that correct?
They do, Mr. Chairman. So any lease expenditures not applied in the year incurred turn into a carried forward annual loss, and those can be used to offset future year production tax liabilities.
And we'll get into that in a minute. Just some of the questions that we're having today or comments are background, trying to, to help people that aren't as familiar with it. We see it every year, but there's a lot of, like I mentioned earlier, there's a lot of new people in the building. It'll be the first time they've actually had to delve into the details, and it's nice for them to connect and use all of the expenditures, not just part of it or part of the revenue. And so we'll go on to slide 23, transportation costs.
Sure, yeah. Slide 23 shows a similar history and forecast for transportation costs. We'll also refer to those as netback costs. These are important to look at because these costs reduce the value of the oil for both tax and royalty purposes. So the transportation costs are all costs of getting oil to market, from the wellhead on the North Slope to wherever it's delivered, be it California, Washington, other destinations. Transportation and costs include feeder pipeline tariffs on the North Slope to get oil from any fields other than Prudhoe Bay to the beginning of the Trans-Alaska Pipeline, and then include the Trans-Alaska Pipeline tariff to get the oil from the North Slope to Valdez, and then tanker costs for getting the oil from Valdez to market, and then there's some other minor adjustments that go into transportation costs. So the average transportation cost for Alaska North Slope oil was $9.77 per barrel in fiscal year 2022. We're forecasting $9.92 per barrel for fiscal year 2023 and $9.37 per barrel for fiscal 24. And we're forecasting that the average transportation cost will actually remain just under $10 per barrel until fiscal year 2032. You'll see there was an increase in fiscal year 22, and we're expecting a small increase in fiscal year 2023 to the total transportation costs. That primarily has to do with marine costs. We have seen that marine transportation costs have increased, and that's been driven partly by higher fuel costs, which again are related to the higher oil prices that we saw last year. And also just some tightness in the tanker and shipping markets generally that we've seen. The expectation is that those marine costs will start to pull back a little bit in fiscal year 2024, and you see that reflected in the forecast here.
Next slide.
Great. Thank you, Dan, for doing the revenue forecast portion. And this is Colleen Glover, Tax Division Director, for the record. I'll give a little bit of context about the slide before going over the graph. So this is looking at a particular subset of oil and gas tax credits. And prior to 2016, some of these credits could be purchased back by the state. That provision has expired, but there still has been a lingering balance. The good news is it's almost exhausted. But there was statutory changes in 2016, 2017 that ended this cash purchase provision. There is also in statute a formula that lays out what percentage of the credits should be funded for that given year, and that is based on a percentage and what the forecasted oil price is. For fiscal year 2023 on this graph, you can see the statutory appropriation amount is the 341, the tall gray bar, and the blue bar is the remaining balance. So in the fall forecast, we have forecasted the 341. Part of that is the 60 million that was a supplemental appropriation in FY23 for FY22, and then the remaining amount based on the current formula. For your information, and we do provide an annual report to the legislature. It's one area in our taxpayer confidentiality statutes where we can actually provide confidential information. So every year, on a calendar year basis, we give a report to the legislature for any entity that received money as part of this cash by taxpayer amount that was transmitted to the legislature earlier this month. We can get you additional copy if needed. But what that report will show is we did disperse a part of this money that was in the FY 2023 budget, about $196 million. The remaining amount now of that appropriation is about $144 million. And just some context about the balance we have paid off We call them buckets. So the tax credits kind of get grouped into the year for what they were applied, and then the payout is kind of prioritized by those annual buckets. We have now fully exhausted the 2016 credits, and now we move into the 2017 that actually are under a different statute of how they are paid back. We are currently just evaluating the timing of the rest of the budget appropriation for this fiscal year, and how we might do that. And one thing to note too is that it's a dynamic number of what's the balance. So we did report the balance as of last calendar year. That number can change. These tax credits can be used by taxpayers to reduce their liability. They can be sold or transferred, and the value might change depending on audits or other adjustments.
So we have one slide left, and we got about 20 minutes, so it's unfortunate for you guys because a couple of questions you can't get away too quick today. So we'll need some help with this subject matter. We, last year in the budget, we're hoping that the liability would be paid off on these credits and it would go away, never come back to haunt us for several years like it has in the past. And then oil prices declined from expectations, and there's like some calculations. So can you help us with what the committee should be looking for this year, and if there's glitches within the current budget that dealing with employment or anything else that may be contingent on this that we need to get up to speed on, and then ask for more information and assistance from the department?
So Chairman Stedman, what you'll see, what I failed to bring up is for fiscal year 2024, the remaining balance that we're projecting is $43 million. So in order to pay those off, then there would need to be an appropriation for that $43 million, or, I mean, that number could change, but that's based on our current forecast. The challenge with the 2023 budget language is it was a not to exceed number based on actual taxes levied. You know, taxes aren't complete yet, so we don't have final numbers. So it makes it a challenge, as Dan's already talked about how prices have changed. So we're evaluating, and it's really uncertain at this time what the final number would be for fiscal year 23 because of the language that was in the budget bill for FY23.
So if you had to get out your Ouija board that you do with your price of oil and your oil production forecast, and you had to give some ideas to the finance committee or some ranges, what should we be expecting to have to deal with the 23 cleanup? And do we need to do it in a supplemental, or should we not get worked up about it and just deal with it in the FY24 budget?
For the record, Commissioner Designate Crum, thank you, Mr. Chair. At this point in time, we're looking at, as we get closer to the spring forecast, to see where our actual FY23 numbers are going to be in the price per barrel and the amount of taxes levied. I think at that point in time, we'll be able to see, can we use the FY23 appropriation to cover FY2017, and how much of that, and what we need at FY24.
So let's go ahead and try to put a little white page together for the members so they can all have it in their particular file, and we'll, pigeonhole a area in the FY23 supplemental and talk about how we clean the rest of it up in 24. So we just kind of keep it in the, in the back of our mind that this is just some cleanup language, but we want to make sure we get it taken care of.
Yes, sir. Thank you, Mr. Chair. We will work on that.
Yeah. Oh, and just for those watching at home, when we do these budgets, we're looking out, for instance, the one in front of us, 24, FY24, we're looking out for the 1st of July of this coming year, clear to the end of next June. So we do the best we can to estimate, but that's just exactly what it is. There's estimations, and then we put language in the budget to control exuberance that may be required in an expenditure that we want to keep track of, or a floor. So we put parameters on it. It looks like, we've got some cleanup to do on this subject. So we'll look forward to working with the department so we can take care of the issue. Senator Bishop.
Thank you, Mr. Chairman. Welcome, Ms. Glover. Good to see you. Where are we at on audited reports on the industry? What year are we in now?
Well, thank you for the question through the chair, Senator Bishop. That is actually the next slide and the last slide.
We'll speed on to slide 26, unless anybody has any questions on the current slide. Okay, go ahead. Ms. Grover, can you help Senator Bishop with his question?
So for the record, Colleen Glover, Tax Division Director, just to kind of give some context about why this is even in this presentation and why we talk about this and kind of the uniqueness of this. So our oil and gas production tax audits are the only tax program in current statute that have a 6-year statute of limitations, and that all the other tax programs have a 3-year statute of limitations when the state can issue an audit. That was changed for oil and gas production taxes back when we converted from a gross tax to a net tax, realizing that it was a new tax system, it would take a lot of work. Over the past several years, there's been efforts to try to move to a 3-year audit cycle. There's benefits for both the state and the taxpayers for that. It's difficult when a taxpayer waits 6 years to find out what the state's positions are, and then during that 6 years, there's, every year they're filing returns and they don't know our position. So there's been a lot of work over the years to catch up. We've had good success. So you can see we have completed all of the audits through tax year 2017. Tax year is the same as a calendar year for production taxes. We are working on the 2018 and 19 to get those done here later this year, and then working on to 2020. We're not always perfect, but and the thing to note too is this is kind of all of the audits that we do. Some of them don't take as much time, some can be sooner. So, we could have 18 and 19 audits done for some taxpayers and the larger ones not. So it's kind of a mixture, but when we report, it's like when all of the audits for that year are complete. One thing that's really helped us is getting funding to implement a tax revenue management system. We have a very robust system. The oil and gas audit team, production tax audit team, they're truly paperless, and we have this robust system that allows us to look at all of this data. And if you can imagine, for some of these big fields, the amount of transactions that occur in a given year, and we're giving line item transactions that we are reviewing and auditing for accuracy of reporting and for correct statutory interpretation. So this system has allowed us to really leverage and to simplify and kind of standardize how we audit these, and they truly are paperless for these audits. They can go in, our auditors can go in and make the adjustments we see fit, and the system recalculates the amount owed, interest, penalties, and we can issue, audits through the system. So we appreciate getting that funding. That system has now been in place for about 6 years now, but we do continue to try to work collaboratively with the taxpayers to get information sooner in the process, so we can be reviewing stuff and doing preliminary taxes. There's been a lot of strides in that arena, but I feel like we're in a really good place now.
So did she tell us that they're cleaning up the backlog and everything's going better? I think that's what I heard.
Follow up?
Yes.
I was looking at your improvements, and so you're fine with employees, and you're not looking for any more employees, because I don't see employees as a part of your improvements to reach goals, so you're good there.
Senator Bishop, through the chair, I would say we are fine with employees. I mean, we're similar to any other business or state agency. We do have vacancies. We have had turnover, but actually in our oil and gas production tax team, we've actually had pretty good stability, and that has helped us to be able to kind of maintain catching up and being more on track. So we are not asking for more bodies for that group.
So just, I apologize, Mr., just one more. Would you attribute that to maybe the co-chair's improvement to bumping up the wages over there how many years ago?
Senator Senator Bishop, through the chair, I'm not aware of.
Okay, I'll talk to you.
Sorry.
offline.
So just to make it your answer more on point, so what I'm hearing you tell us is the backlog's been pretty much caught up and things are going better. You don't have multiple year delays and you're getting to a point where it's going to hopefully be fairly routine to only be a couple years behind or a couple years look back on the audits. Is that correct?
That's correct. So we have finished 17. We're almost done with 2018, 19. And we're not quite at exactly 3 years. We're in the 3.5 to 4 year kind of return on the audit.
Which is better than 6.
Correct.
Yeah, so it's good news. When we have good news, we want to make sure we point that out. Senator Wilson.
Thank you, Mr. Chair. I also just want to echo, being the past subcommittee chair for the Department of Revenue for the past 4 years, that this has been an ongoing task, and just want to congratulate Director Glover and her team for this great accomplishment.
Thank you.
And if you're back to subcommittee chairman, we expect further improvements from the subcommittee chairman, Senator Wilson. Do we have any other questions or something? This was the last slide. No, we got one more in the back. Let's touch on that one. It's behind the thank you slide in the appendix, which is an important slide, by the way. When we have time, we got about 5 minutes, so let's cover that one as a reminder. Senators are being called to the floor of the Senate. But we have, it's a little bit early, it's 1:45, so we are quarter after, 15 minutes before we're due to report to the floor. So you have about 5 minutes, Mr. Stickel. If you want to take the lead, it looks like you're ready for action down there.
Be happy to. Thank you. Again, for the record, Dan Stickel with Department of Revenue. So slide 29 is an appendix slide that we included as a resource for the committee. Shows how the state receives petroleum revenue based on different statuses of land. And the basic concept of this slide is that not all oil is the same. So the state receives production tax, corporate income tax, and property tax on any land in the state or any offshore waters up to the 3 mile limit, regardless of the ownership of that land. Royalty, on the other hand, varies quite a bit depending on the ownership of the land. So there's different royalties that apply for state land, for private land, for different categories of federal land, whether it's the Arctic National Wildlife Refuge or the National Petroleum Reserve, and other land. So I'd be happy to walk through this, or we can just leave this as a resource for the committee to remember that.
Well, maybe just touch, if you could, just some of our bigger developments are going into NPRA. Maybe just touch on NPRA, and then maybe ANWR, just the two middle ones.
Sure. So for NPRA, which is an acronym for the National Petroleum Reserve Alaska, that's federal land. There are some private leases within the NPRA as well. For the federally owned land, federal royalty will apply. Half of the federal royalty gets shared back to the state of Alaska, but we consider that as restricted revenue. The half of royalty from NPRA that's shared back with the state has to be used to benefit the communities that are impacted by that development. And then also within the NPRA, some of those leases are also on private land. That's a privately negotiated royalty with the landowner, and the state does not receive a share of the royalty. but we do levy a tax on the value of the private landowner royalty. It's a 5% gross tax for oil and 1 2/3% gross tax for gas on the private royalty value. Over in Anwar, if there were to be a development there, and for any of the bonuses and rents that have been paid thus far, federal royalty also applies in Anwar, and again, 50% is shared back with the state. Currently, there are no restrictions around how that 50% share is used, so that would be considered unrestricted general fund revenue.
Okay. I think this chart is very handy, and please bring it up with a lot of the newer members, because it's a struggle when you get all these moving parts in our oil and gas industry to understand it and recognize that all oil is not the same, and all revenue doesn't come to the state from it. So, well, with that, is there any final questions from committee members? Seeing none, I'd like to thank the department for coming forward. Please try to, respond back with the updates, data sets, and then we'll get with you guys dealing with the revenue as we go through and try to do our projections on cash flow and expenditures, and particularly cash flow over the next 4 or 5 years, to make sure we're here for the 10-year. With that, that concludes the meeting today. Next meeting will be Monday, and we'll have a brief at ease.
All right. Hello, my fellow Alaskans. Thank you guys all for tuning in here today. Man, people really, I really do got to redouble check what I put up as a title there. I was looking at another committee meeting that they had going on here, which was Department of Labor, and somehow I had typed that into the top of the head bar there. I did correct it while the feed was going, but I just shake my head when I see little things like that, and it always just kind of annoys me, the little stuff you miscatch as you're trying to put things together and get prepped for things. All right, thank you guys all again for being here today. If you have not liked and shared this video, please do that right now. This is one of those what I classify as all important videos. This video here is the Department of Revenue spelling out every penny that our state has to spend. Every single penny. And if I caught the numbers correct out there, they have $8.7 billion this year. That's correct. $8.7 billion this year to spend. The budget is about 4.6. If they were to do a traditional budget, it would be closer to 4 billion, not 4.6 billion. And but they got 8.7 billion, which was $1 billion more than what I was expecting there. I was only expecting around 7.7 billion dollars, and to see 8.7 thrown up there onto the screen, I was like, oh my gosh, it's $1 billion more than I expected. And yet they try to paint this, we didn't make as much, this grimmer outlook, because the production levels weren't quite as high as what they were the year before. Production levels don't mean crap when you are looking at, and when I say year before, this is pre-2022 July. So it'd be from June back from 2022 is what they're, when they say pre, because the current cycle right now is July 1st, 2022 to June 30th, 2023. So when you look at the revenues that they're talking about right now, that $8.7 billion, they only have about 6 months of solid data, and they still have 6 more months to go before they'll have the rest of the projected revenue of that $8.7 billion sitting there that they're expecting. And they're only expecting about a $6 drop, $7 drop in barrel prices from $87, $88 a barrel to $81 a barrel in 2024, 2025, and kind of holding steady throughout for the next few years. So they're over $20 a barrel, and literally, if you were to break that out, $20 a barrel at 500,000 barrels a day, 365 days a year. That's how much money they have above and beyond what they need from the oil company. So they claim their revenue that they get, that they need to be able to cover the Alaska state budget. But the narrative they spun today, that they spun in the DNR presentation of future production of the natural resources that they have, that it was just a production forecast. They didn't give you any dollar figures. That's what today was about. They gave the dollar figures to what that forecast was. And that's why I kept saying, here's the second time they've spun the narrative, the third time that they've spun the narrative about who owns the land. They're trying to make a very big distinction between the federally owned land, state-owned land, and privately owned land. Since less than 2% of our entire land mass is owned privately, so to speak, there is nothing out there to even calculate to put into that total for those royalties coming in. So you go to the state-owned land, which currently is set up as a 90-10 split with our federal government. Alaska gets 90%, federal government gets 10%, and then Alaskans do a royalty split that goes into our permanent fund corporation of 10%. That is a 5% split under the Hammond law rule, that how that money is supposed to be split, that goes towards the royalties into the permanent fund corporation. And that's where they give the POMV law, the percentage of market value, the 5.25%. Going by their totals of what the permanent fund is supposed to be, we're looking at like $3.3 billion this year for the permanent fund corporation. That would be calculated between all Alaskans, and that would be what our next payout would be based off of. But because of the POMV law, that is about $1 to $1.6 billion more than what they want to take and are allowed to take, because they've got all of this 5% POMV that they're able to draw from that, and to be able to cover what they want to spend on government, which is increasing the student base allocation. So our schools are being filtered in more cash to do absolutely nothing, so the upper management administration can keep lining their pockets, so that we can keep covering the costs of also the Biden inflation, causing our rural communities, just for the heating oil of the schools, to cost 300% more than it was the year before. Got into that discussion here, I think it was just yesterday or the day before, and it was one of those things that it just the costs are going through the roof, and these problems have been here for decades. It's not like this just happened overnight with the Biden inflation. These things have been around forever, and they just want to keep throwing money at it for the worst results at double to triple the cost of anywhere else in the nation. We need to bring this under control. They obviously don't care about, I didn't hear a single question from those in the Finance Committee. What laws can they pass? What rules can they change? What can they do to make it easier for them to get that oil into production, get those mines mining, get those forests being cut down and replanted, whatever it takes, get that gold being mined, get those rare earth minerals out of the earth. What are they doing? What could they do to help increase that, so that they can increase the revenue coming into the state to cover what they consider their expenses for all of us? Yes, all of us Alaskans, yeah. I really want to put another word in there, but keep this PG-13. And so, yeah, this is just kind of where we're at in the world today. And the meeting that I listened to there, the narrative that's being spun, they have everything they need to be able to pay for government this year, and still have a surplus sitting there of around $3 billion, if not more. if the predictions of what they said that the total amount's supposed to be this year of $8.7 billion to be able to spend on government. With only a $4.65 billion budget, whatever the governor just got done proposing, and it paid out the full statutory PFD, and it continued to fund government at the levels that they are currently at right now, and it left a lot of room for our government to take the opportunity, which we give them every single year, to reorganize where that money is going and take a deep dive into correcting what is not working. If our school districts and university in Alaska was a business, they would have been bankrupted a long time ago and replaced with something else that works. And but no, not when it comes to our Alaska government. They just shovel more money at it and say, oh, we can fix it, we can fix it. More money is the cure. It's not the program that we're presenting. It's not what we're teaching their children. It's not the woke agenda that has now taken over the control of the schools and made it to where it's almost nearly impossible for teachers to even to attempt to teach these children, because they're taught to give them a gold star just for participating, no matter how good they do. And it's just, that's a never-ending perpetuating cycle. I mean, Juneau, they just completely cut down public testimony in their school boards there to 60 seconds. You get 60 seconds to plead your case in front of the school board in their school board meetings, and in front of their, and this is all you get, 60 seconds to plead your case. Anchorage completely shut down. Anchorage Assembly completely shut down all public testimony at the beginning. You no longer even have that option anymore. This is what the woke extremist agenda that's out there, whether it's coming from the Republicans or the Democrats. This agenda's got to be put to an end. We need to start putting the people of America, the people of Alaska first, and we need to make sure that our agenda, the one that benefits every single one of us, no matter how you, in the words of the woke generation, identify, we all need to be on the same page that we're here to coexist with each other no matter what, and quit dividing us apart. And this meeting with the Senate Finance today, it is most important that I think that you get this liked and shared. If you haven't liked it right now, go ahead, like this video, share this video, follow us on Twitter, Facebook, and Rumble, all at Politadick. And you can easily look us up. And while you're at Rumble, please make sure you subscribe there. We're now a little over 50. The last time I looked, I saw a couple more new messages saying a couple more people have subscribed there. Maybe we're over 60 now subscribers. Once we reach 100 subscribers, we can live stream to Rumble direct. We don't have to wait 4 to 6 hours later or 12 hours later for it to propagate over to Rumble so that you can watch this broadcast there. Your subscription will help make us get it there that much quicker so that we can just be able to stream directly to them and cut out the middleman of having to wait. And I just got the best news of my life today. I got an email that says that all of the mitigation of my website and register and all that good stuff has been 100% confirmed, completed as of this morning for my website. So that to me means that there might be a page here real soon that you can actually go to again. After a month and a half of waiting, I am so happy to be seeing that website is finally going to get back up and where it belongs. So you can also catch broadcasts like this one live there on our website if you like. And also while you're there, don't forget, go to the support page, click the support button, and all proceeds go right back into doing what we're doing here. Right now, I should be doing my normal job, earning my living that pays the bills, keeps the lights on, pays for just about everything that I need for my survival, but it doesn't make enough to do the extras that stuff like this. the restream services that, you know, there's an extra grand a year, the website, you know, there's money out the door. All these things add up dollar-wise, and it's your support that has made that happen. It's people like you that made this broadcast possible. So please help support us, keep helping us grow. We use that money to do nothing more than keep expanding what we're doing. We've upgraded microphones, laptops, camera equipment, tripods, the cradle cages for the actual cameras so there's less vibration, quality wireless microphones that can be reached and connect every single time. It is your support that made that all possible, so thank you. So again, one more time, you can find this right now on Twitter, YouTube, Facebook at Politadick and Politadick Unfiltered. It will be on Rumble here real shortly. This also should mitigate over to NorthTube, and you can find us there at Politadick. As with everywhere else, we are Politadick everywhere. Thank you guys all for tuning in here today. You have been a great audience, and don't forget, like and share.